Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Asana. So, Asana is an interesting business, and it's one that I actually was quite quick on Seeking Alpha to be one of the first people to highlight it as a potential investment opportunity. And I continue to be quite bullish about it pretty much all the way up. And then towards the top, I kind of made an about turn and said, okay, I don't think that the valuation makes sense anymore. And now that it's fallen, the interest in the stock has largely faded, and I believe that they're going to have to raise some equity soon. But even with that consideration, the stock is now priced at 18 times forward sales, and I think that it's now much more attractive than it's been for some time. So I'm going to go through this and highlight, some of the thoughts that I've had about this company. So in the past 3 months, the stock has just been, obliterated. Uh, and what's quite interesting is that you can see here, I was really bullish the company. So you see here, starting in November, in November 2020, I was one of the first people, and I remained. You can pause the video if you need to, and I remained very bullish this company all the way up until August 21, when I wrote still attractively valued even after the rally. So I was kind of like bullish, 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 and then in November, I wrote that it was difficult to justify now. And in that article, I highlighted even though it's an amazing company, amazing this and amazing that, the valuation just didn't make sense. And since that article in November, the stock is down approximately 50%, and you can see this for yourself. So I was able to not only call it on the way up, I was actually able to kind of call it impeccably on the way down. And if it's quite difficult to do, to call on the way up and on call on the way down, and it stands to reason that if I can do so, I have an above average insight into this company's potential. So there's a lot here to like about Asana. And the stock is about to report their Q4 2022 results next month. Just to remind you that the fiscal year and calendar year are misaligned here, so I'm just going to report about its fiscal year. Okay, so the guidance for Q4 is pointing to approximately 54% year-over-year growth rates. Now, keep in mind that Asana has a habit of low guiding and beating on the estimates. You can see here that they've consistently beaten by more than 5% on the top line. So it stands to reason that when they report next month Q4 2022 results, they will probably be growing at the next to 60% year over year. So it's clearly a company that is doing great things, right? And I really like their messaging. So they're focused on the three W's, like who's doing what, why, by when, and that's really something that, like, it's just so clear and concise. So it's a platform that allows everyone to work in a hybrid environment, to coordinate strategies, to distribute content, and I mean, it's really well positioned. There's a lot here to like about it. And one of the things that has always compelled me towards this investment is what makes it stand out better than its competitors is that its ability to not only have a large amount of customers growing towards this platform. I've always said, follow the customer growth, but its net retention rate is clearly above 120%. You can see here on the screen. So, it's a business that's clearly well positioned, A-class management, doing all the right things, right? Now, a few months ago, if I was to say to you, okay, let's discuss his profitability, that would have just fallen in, would have been just no point even talking about that much. But right now, I think that people are more reasoned, and there's a lot more investor sentiment that's kind of calmed down slightly, and many investors are starting to believe whether buy and hold always makes sense. And even if you are aligned with an A-class management that holds plenty of stock in the company. So now people are kind of calmed down, and it's probably a different time now to start thinking about this. So here's the thing, right? On a non-GAAP basis, Asana's profit margins are typically around negative 40%, okay? The guidance for Q4 is pointing to approximately negative 48%. Now, I suspect, as you do as well, that Asana will beat that guidance with ease. So instead of being negative 48%, it'll be negative 40%. Okay, so clearly, no batting around. We're kind of close to every dollar that they make. They have to make a 40%, 40-cent loss on a non-GAAP basis. Okay, now you can probably pause the screen here because this looks a bit small, but the way that they calculate the free cash flow is that they add back property and equipment. Now, for many investors, property and equipment is also known as capex, and you would subtract that out of the free cash flow, but they add it back. Um, so I don't know. You can do what you want, but it's still an outgoing cost, right? So by my estimates, they'll report negative 120 million of free cash flow when they report next month. So given that its balance sheet only carries approximately 340 million, I'm thinking to myself that if you're burning through more than 100 million, even if they improve the operation slightly, you're burning through 100 million. That means that you only have about 2 years left, roughly 2 years left of cash on your balance sheet. And keep in mind that nearly 50% of Asana's free cash flow is stock-based compensation that gets added back. So if you want to keep, if you're Asana's CEO, whatever, founder, and you want to keep key talent in your C-suite, you're going to have to support that incentive package in some way because the stock is down, so they're like, the C-suite will be thinking themselves, okay, I want to get paid, I've got all my credentials and everything, and I'm not sticking around with no company where the share price is down. So they'll have to kind of be supported, which is obviously going to cost the company even more. So this is just something to think about. Now, there's a lot here to be kind of, bullish about this. So if we were to make the assumption that Asana is going to grow in fiscal 2023 by approximately 40% year over year, this puts a stock priced at approximately 18 times forward sales. So this is clearly much cheaper than it was a few months ago. A few months ago, this was priced at north of 50% forward sales. So momentum has now kind of faded away. The stock, and the thing is, the sentiment plays the two ways, right? So it plays when everyone is going like, oh, it's going up, and it's good. Like when it's going down, everyone's like doom and gloom. And when it comes to it, right? So you don't want to be really, really quick to kind of get in as soon as the stock starts to correct, but you do have to kind of start thinking about it from the fundamental point of view. Okay, so compared to Monday.com, Asana is trading at a small discount. To illustrate, Monday.com is priced at 20 times forward sales, which is 2 turns higher than Asana at 18 times forward sales. On the other hand, Monday.com's fundamentals is really, really strong, and it's growing faster than Asana with better bottom line prospects. So, in that context, it probably is justified that Monday.com would be priced slightly more expensive. But it doesn't detract that the valuation now, if you get in a business, it's probably going to be growing at close to 60%. I mean, even if it slows down in fiscal 23 and it only grows by approximately, close to 35, 38, even 40%, that's fairly, that's nothing to sneer at. Now, when it comes to deploying capital, a lot of people get really emotional and they buy into narratives and they get really attached to their stocks, and even when the valuation doesn't make sense. And on the other side of the coin, when the valuation does start to make sense, people kind of, I don't want to buy. I was like, I wait for a better time. And you don't want to buy as soon as it starts to correct, but you want to try and buy when people are kind of despondent and not really motivated to get involved in the company. All this being said, personally, even though I do think that Asana is a great business model, I will not be deploying my capital right now. I'll kind of still wait until the valuation makes even more sense. But if you want to find out what stocks I'm buying where I believe that the valuations make a lot of sense, don't forget to check out our marketplace. It's called Deep Value Returns. You can see it there above the screen. And yeah, I hope to see you soon. Don't forget to check out the reviews that other people have seen from my marketplace. And yeah, thank you so much for listening. Bye-bye.